Hi viewers, welcome to Money Manthan TV. Today we are with C. Hanuman sir. Today's topic is income plus arbitrate fund of fund.
Yes.
Sir, what is this topic regarding?
See, fund of there is a new concept allowed by the SEBI,
Okay.
Securities Exchange Board of India, which regulates the capital market in India. So this is fund of funds is a new concept.
It's called FOF, sir.
FOF. It is
Okay.
called FOF. So it is attracting interest from investors who wants fixed income. Means those who wants fixed income, just like interest income. They are ready to take risk to some extent, to some extent they want a certainty of their income. So for this fixed income and also to tax efficient, less tax burden, people are opting for contributing for investment fund of funds. The main idea of this fund of funds is 65% of their funds received from the investors will be used for the fixed income, means debt funds, government securities, bonds, or deposits. Is fixed income groups. Only 35% they will invest in mutual shares market or equity market, any that is arbitral market, that is other market, flexible market, and all the investments which are invested by the in fund of funds, and if it is withdrawn or if it is encashed, that if it is held for more than 12 months, it will be called as a long-term capital gains. The tax liability is less. So because of this flexibility, less tax liability and assured income, many investors, especially middle class, senior citizens, they are going for investment in this fund of funds. And what is happening is, if the investment is for more than 24 months, it will be taxable at 12.55% only. And this is open-ended mutual fund. Means anytime you can invest and you can withdraw according to after some time you can withdraw whenever you want. This is called open-ended scheme. Mutual fund scheme that primarily invests into two types of distinct categories: mutual fund scheme, debt-oriented schemes. I told you, debt-oriented scheme means it gives fixed income, and mutual fund scheme means it is the investments in shares or any other price variation investments.
Okay.
So debt-oriented funds and schemes, arbitrary schemes also they are investing. And because of this combination of 65 and 35%, it gives stability of income because from the debt portion and risk-taking capacity of investing in equity market.
Okay.
So this is two types of income the investors are able to enjoy. For this purpose, they are investing more in fund of funds, along with tax efficiency and low risk returns. And risk is also very low because of only 35% is risk investment and 65% is fixed income. So out of these, there are 18 schemes are there in fund of funds. That is, until now, 21,000 crores has been issued by funds of funds up to 30th September. And these funds of fund will dynamically allocate their funds to achieve their two goals, that is fixed income as well as tax benefit to the investors. So this will make more attractive to the investors. And the remaining 35% they will invest in arbitrary schemes. So the fixed income investments are corporate bonds, government securities, or we can say deposits. All this is also fixed income groups. And the arbitrary portion is on the share market, mutual funds, and which depend upon the market situation. So are we invested in a scheme that capitalizes the price differences of the same security between the cash and future markets? But the risky investment is these fund of funds are investing in 35% in equity market, mutual fund. Also, they are investing in futures and options. This is dangerous because in majority of the cases of futures and option investments, 90% of investors lost money, only 10% has earned the money, and that's also very nominal. So further, what we say is, instead of allowing the fund of funds to invest in futures and option market, it is better go for fixed investment or long-term delivery-based investment rather than future market options. So that will reduce the risk, and also that will reduce the, of course, there may be loss of profit also may be less, but risk will come down.
Yes.
That's the most important thing to protect the investors. So what we suggest is, don't allow these fund of funds to invest in futures and options, future markets. Let them invest only in equity market or mutual fund. That is also, equity market means where the PE ratio is less than 10 and price of a IPO is not more than 5 times of the face value. Now the IPOs are coming with a face value, with a market value of more than 20 times, 30 times of the face value. This is dangerous.
Hmm.
So suppose one person share, company share is issuing for 1 rupee, face value 1 rupee, they are issuing issue prices 300, 200 like that.
Okay.
It's very dangerous investment. How long can you have to wait for to earn that profit?
Yes.
So it is not advisable. If the price value, IPO price is more than 10 times of the face value, it should not be allowed. These funds should not be allowed to invest in such IPOs. If the P ratio, price earning ratio of any company, existing company share is more than 10, these funds should not be allowed to invest in these funds, in these company shares.
Okay.
Then of course the profit may be less, but the risk is less.
Hmm.
Because all of these investments are from middle class people, retirement people, senior citizens, who expect that these funds will use the money, their investment for riskless fixed income investments.
Hmm.
But if they are going for higher risk investments and there is a huge variations in the prices, it will definitely is going to incur damage to the loss to the investors. That is going to affect the entire mutual fund market.
Hmm.
Not only that company, entire mutual fund market. That when the confidence lost by the investors, everybody will try to withdraw money. For this purpose, to meet the withdrawal of money demand, the funds has to sell the shares. And if you are going to sell the shares, the market will come down. Investors will get less. So again, the investors will not show confidence to
Hmm.
invest in such a mutual fund. So every mutual fund which is going to invest others' money, maybe investors' money or depositors' money, any money, don't allow them to invest in IPOs which is having 10 times more, which is having issue price more than 10 times of face value, or existing shares which is having more than 10% of PE ratio. These two conditions fulfilled by the mutual funds, majority of the investment will be safe. You cannot say that there may be a loss, but a very minimal loss, and the investments also will be investors also will get at least confidence, better confidence. So these precautions should be taken by the managers of the trustees of these funds.